Okay, guys, welcome to today's session. So this is class 2 of the 4 classes for FAC4, for FAC1, FAC3. So what we're going to do today, yesterday we read majority of the scenario, and I said you just needed to revise the scenario so that when we come today, you will know what we are doing. So we're going to jump straight into part A. So what I will be doing is I'm probably going to work through this question paper as much as possible, and I'm going to switch out one of the other questions. Okay, so I'm going to have a look tomorrow. Then one of the other questions I'm going to switch out because the full paper is quite good. So what I'm going to do today is part A, and then we're going to set up part B. So then tomorrow we're going to use tomorrow's session is going to be quite intense because that's going to be the impairment, the PP impairment question that we're going to have to deal with for the full 90 minutes. So today I'm just going to do part A, and I'm going to set up part B. Okay. And then on Friday, we're going to do I think a statement of change in equity question. So then I'm going to tell you what you must work through, because there's some parts you're going to have to work through on your own before the class. So I'll tell you that tomorrow which ones. You don't have to go into detail, you just need to read through, get an idea. So that when I talk through the numbers, you have an idea, because I'm going to do the statement of change in equity question because it's important that you can handle a statement of changes in equity type question. Okay, so that is basically what we're going to deal with over the 4 days. Just take note that although we only do 4 days per subject, you're obviously more than welcome to message me if you have any questions that you're struggling with when you while you do your own studying. But obviously you must give me at least like a 2-day turnaround time to actually respond, because obviously I'm gonna have to read the scenario. So even though you have one line they want to ask me, in some cases I'm gonna have to read the entire scenario to actually be able to give you a proper answer. In other cases, will be very quick. Just look at the solution. I'll be able to see what the issue is. But in some cases, just to give you a proper explanation, so you can understand, I need to actually go through the entire scenario. Okay, so that is why I need some probably like a two-day turnaround time. So I'm gonna jump straight now into part A, and then we're gonna work through that. So I'm going to share Google Sheets quickly. Okay, so this is Google Sheets. So this here is Cable Ltd. And we're going to do part A. So today we're going to do part A, and we're going to set up part B. Okay. So let's have a look at part A. So if you can, maybe I'll just share my screen for that as well. So here part A is saying, prepare the journal entries that Cable Ltd has to process in order to account for the foreign loan in its financial records for the years ended 28 February 2019 and 28 February 2020. Okay, so remember, you need to do set up the prepare the journal entries. So I just squeezed through this required and stuff. So I think this is probably the easiest. within this question. Okay, so this is like the easy 14 marks. Okay, so this question was basically to give you some form of motivation that score almost full 14 marks over here. That puts you on, give you momentum, gives you motivation to go on into the more killer type question. So obviously this this over here is generally, impairment is generally challenging. Okay, but remember, if you work through how we went through it for those that joined me in whenever we did impairment, then it should be fairly easy to work through impairment. So let's have a look over here. Where was this long thing? Okay, so here's the loan. Okay, so you see that asked you for the loan. So you merely basically have to read that few lines over here. We're basically just going to read this few lines over here. That is going to, that's where the 14 marks is coming from. Okay, so they want 28 February 2019 and 28 February 2018. I always suggest to students is that write down your financial year. Remember, it's very important to reduce, to minimize the cognitive load on your brain. So by default, when you study and when you write an exam, the cognitive load on your brain is heavy, is high. So you want to minimize it as much as possible. So you just take note that whenever you study, by default, the cognitive load on your brain is going to be high. So when you write an exam, it's also going to be high. So remember, the more, the higher the load on your brain, it's like a computer processing. The more it's on the more information stored on a hard drive, the slower it will operate. As you add more information and the hard drive becomes more filled, it starts to slow down a bit. The same thing with your brain. So that is why, although the brain is much more sophisticated, but just to give you an idea. So that is why you want to deal with certain things in a manner to reduce the load on your brain. Okay, so writing down the date, there's no need to try to remember the date. Just write it down so it's easy for you to see the date. So you don't have to keep that in your mind. Because remember, there's many times where we make a mistake solely because of the date. Everything else is right, but because we got the financial year incorrect, it messes up your answer. So do yourself a favor, write the date down. So what are the dates? It is 28 February 2019, 28 February 2020. So that means we're working from 1 March 2018 to 28 February 2019. 1 March 2019 to 28 February 2020. Okay, just take note of that. Okay, so now let's process the journal entries. Now, when you want to deal with journal entries, remember, we're dealing with a loan. Okay, so a loan, and we know this is a liability because we are borrowing money, so, or we are lending money. So therefore, whatever it is, we are borrowing, lending, whatever. But anyway, we owe. We borrowing money from the Chinese company, so we owe the Chinese company that $240,000. Because we owe that $240,000, we have a liability. So remember, a liability and an asset goes through 3 stages. It goes through initial recognition, subsequent measurement, and derecognition. You need to identify which stage you are in. So in this scenario, because we're doing 2019 and 2020, we're going through each phase: initial, subsequent, and derecognition. Okay, so take note of that. So if I now switch over into Google Sheets, we want to do journal entries, right? So 28 February, I just want to make this for ourselves. Financial year end, FY 28 Feb 2019. FY 28 Feb 2020. Okay, we're going to need debit and credit, and we're going to need debit and credit. Okay. So now in 28 February 2018, remember the year starts 1 March 2018. So on 1 March 2018, we received money for the very first time. That is initial recognition. So on initial recognition, we're saying debit bank, credit loan. Okay, so we're going to say debit bank because we're receiving cash, credit loan. They are both SFP because bank is an asset is SFP, loan is a liability is SFP. Okay, just important also, this is happening on 1 March 2018. Okay, so you can put in your narrations. Let me just quickly check. What did they say about the required? So I say ignore tax, journal should be dated clearly and presented in date order. Journal narrations are not required. Okay, so no tax. We must put in the dates, but no narrations. Okay, so perfect. Okay, so okay, so now we're going to deal with this amount. So remember what's going to happen over here. We received $240,000. Okay, and we multiplied by the applicable exchange rate. The applicable exchange rate will be the transaction date rate. So it is going to be the spot rate on 1 March 2018. So the spot rate on 1 March 2018, the spot rate on 1 March 2018 is 12 Rand 95. So we'll go over here, 12.95. So the spot rate would be debit bank. What is that? $240,000 times 12.95 equal 12.95. Okay, so that is 1 March 2018. Okay, next, what do we have next? So next, what happens is that, so we know loan is paid 10%, so they say March, okay, the loan bears interest at an annual interest of 10%. You may assume that this rate is the market-related rate for the duration of the loan. Interest payments are payable annually in arrears, and the capital is repayable on 28 February 2020. Okay, so we're going to have to account for two things. Number one, we're going to have to account for, so number one, we're going to have to account for interest expense as well as the interest payment. And number two, we are going to, what we're also going to do, we're going to deal with, exchange rate movement. Okay, so we're going to have to deal with those items. So let's do the easy one, which is the exchange rate movement. So here we're going to have 28 Feb 2019. Okay, so what we're going to do with the loan. So remember, we need to see what is happening with the loan. So we know on 1 March 2018, the balance is 12.90. The exchange rate is 12.95. So how much, if we were to settle the balance on 1 March 2018, just think of it like this. If we had to settle the balance on 1 March 2018, the exchange rate that we would have to use in order to pay back is 12.95. But now we are at 28 February 2019. If we were to settle at 28 February 2019, we'd have to pay an amount based on the exchange rate of 11 Rand 80. So as you can see, the exchange rate over here decreased, and that decrease is favorable. Why? We're going to have to pay a loan. We're going to have to pay back 240. If we were to pay back $240,000 on 28 February 2019, we will use an exchange rate of 12.80 opposed to what it's currently sitting at, 12 Rand 95. Okay, so you can see the loan amount would reduce. So as a result of that, the loan amount is reducing. The loan is a liability, and as a result, the liability is decreasing. A liability decreases on the debit side. So I'll have loan, SFP, and what is it as a result of? It is a result of foreign exchange movement. Foreign exchange. Okay, foreign exchange goes through profit or loss. Okay, so Forex goes through P&L. So what's going to happen? The loan is $240,000, but I'm now have to pay 11 Rand 80 as opposed to 12.95. Okay, as opposed to 12.95. So I'm going to be paying less, and as a result, I'm going to be paying less. So as a result, I will, I'm paying less, so therefore the loan would reduce. So I'll say 240, 240, 123 multiplied by 11 Rand 80 minus 12.95. Okay, obviously it can't be a negative answer because journal entries are not negative. So I'll just make it positive. Okay, so the loan is reducing by 276,000 because the exchange rate has become favorable. So what's very important to understand, you need to identify who you are. Are you the person receiving money, or you are the person paying money? Okay, so for example, if this was an asset to us and the same exchange rate, then it would be a loss, because now instead of if the person had, if we had to receive our asset on 28 February 2019, our asset would be worth 240 times 11 Rand 80 opposed to 240 times 12.95. So as you can see, the asset would have reduced. So if an asset reduces on the credit side, then you know say credit asset and debit Forex gain or loss. So that is why it's important to understand from which perspective are you looking at it from. Okay. Okay, so that's the first aspect. The next aspect is the actual interest income, as well as, so the next aspect is the actual interest income, as well as not interest income, interest expense and the interest payment. Okay, so that's important to take note. Let's see something. Okay. So what we're going to do is going to deal with what we're going to do. We're going to deal with the interest expense and the interest payment. Okay, so remember, interest expense is a expense. The expense is increasing. An increase in an expense reduces profit or loss. A decrease in profit or loss decreases equity. Equity decreases on the debit side. So therefore, interest expense or finance cost, whatever you want to call it, finance cost, interest expense, doesn't matter, is debited, P&L. Okay, so remember, finance cost, interest expense is an expense, and it is increasing. The finance cost is increasing. So because the finance cost is increasing, expenses are increasing. When expenses increases, profit or loss decrease. A decrease in profit or loss decreases equity. Equity decreases on the debit side. So that's why we say debit profit of finance costs. Then we're going to have to make a payment. Okay, so we're going to have to make a payment, and this payment is your interest payment. Okay, so we call it bank because you don't have an account called interest payment. The payment is as a result of interest, but it's going through bank. Bank is SFP. How much are we paying? Remember, we're paying 10% on the loan amount. The loan amount is 240, 123 times 10%. So the loan amount is $240,000 times 10%. So whatever that answer is, which is $24,000, that is the interest payment we have to make. But remember, we're not going to pay it in dollars. We need to pay it in rands. And what do we know? We're paying it on 28 February 2019. So therefore, we will use the spot rate as at 28 February 2019, which is 11 Rand 80. So because we are making a payment, bank is decreasing, bank is an asset, and so assets are decreasing, and assets decrease on the credit side. So we're going to say credit to 123 times 10% times whatever that is, 11 Rand 80. Okay, so that is our payment. Okay. Okay, the next thing we need to deal with is the finance costs. So the finance costs would be as follows. $240,000, 1, 2, 3, 1, 2, 240, 1, 2, 3 times 10%. Okay, but now this is relating to finance costs, which we have incurred throughout the year. Because we have incurred interest expense throughout the year, the exchange rate that we use is not the spot rate, but rather it is the average exchange rate for the 2019 financial year. Just so you know, on a strict basis, strictly speaking, you need to basically do the exchange rate. I mean, you must calculate interest daily, and then the exchange rate must be every single day. So you must calculate every single day. You must do an exchange rate. Now, obviously, that is not practical. So that is why an average is okay. Okay, so just take note of that. So an average is okay. In the real world, most companies use average. However, like auditors will check, okay, to see whether it's not materially misstating if you just use an average. So they do check those type of stuff. But because it's generally not going to be have a massive impact materially, so therefore an average exchange rate is totally fine. But strictly speaking, you need to do it as a transaction happens. So you're incurring interest throughout throughout the period. So therefore you need to do it every single day effectively. So the average exchange rate from 1 March 2018 to 28 February 2019 is 12 Rand 375. So it is 12,375. Okay, so it's very important to take note of that. Now, as you know, we're not yet done. But let's just put it in. Remember, I'm debiting finance costs. Why am I debiting finance costs? It is because it's an expense and the expense is increasing. Okay, so that would have been the amount. But remember, in this scenario, this is specific to this scenario. Okay, so this is specific to this scenario. So recall under the if you go one page down on page 6 under the heading HDCW plant. Remember that in that first paragraph they talk about borrowing costs. So they said that the borrowing cost incurred as a result of this whole thing was 37,125 Rand. Okay, so basically, of this finance cost, of the cost 297,500, included in 297,500 is borrowing costs of 37,125. So included in the finance cost is borrowing costs of 37,125. Now remember, borrowing cost is not expensed as finance costs. Borrowing cost is capitalized. Borrowing cost is capitalized to the asset. So what we'd have to do, we'd have to take the borrowing cost out of this 297 and put it as an asset. So we must recognize it as an asset. So we take it to the asset, we capitalize it to the asset. What is the asset? The asset is the plant. So that will go to SFP, and that is 37,125. It was given to us, and it's included in here. So therefore, we need to decrease. Okay, for CTA level 1, you can ignore the borrowing cost issue. For CTA level 2, you might just be aware of that. So for CTA level 1, there'll be the same question. They can give you the exact same question, but they would exclude the issue of borrowing costs because it's not covered in CTA level 1. But take note for CTA level 2, included in this finance cost is borrowing costs of 37,125. Borrowing costs should not form part of finance costs because it's not expensed in the period, but rather it is capitalized to the asset. Okay. And then the borrowing cost that is included in the asset will be expensed over time through depreciation. Okay, so just take note of that. Okay, and then does this journal entry balance? You have to check if the journal entry balance is most likely not going to balance because there's a difference over here. We're using 1237 and here we are using 1180. So it most likely won't balance. So therefore the balancing figure would be Forex. Okay, so we'll just have a look. So we are missing 13,800. So we're going to credit 13,800. So once again, we made a Forex gain. Okay. So just take note of that. So that is 28 February 2019. So what did we deal with over there? It was the foreign exchange on the loan, and then it was the finance cost payment. Okay, so there's nothing else to worry about over there regarding the loan. Now we're going to deal with, what are we dealing with? So remember, on 1 March 2019, nothing happened on 1 March 2019. So all that's going to happen now is the journal entry on 28 Feb 2020. Okay, so that's all that's going to happen now is a journal entry on 28 February 2018. So what's happening on 28 February 2018? There are three things that is happening. Number one, it is in no particular order, but number one, it's going to be the forex on the loan. Number two, it is going to be the finance costs and finance and interest payment. And then number three, it's going to be the repayment of the loan. Okay, so that is basically, remember, journal entries can be done in any way. Okay, as long as you end up in the same answer. There's no one way to do a journal entry. So you do it as best as you want to. So I'm doing it that makes logical sense to me. Okay. In most cases in the real world, they prefer journal entries as detailed as possible. The reason being is when they go back to so like I have that experience when, as a financial accountant, you rather do a journal entry in as much detail, because sometime later down the line you're going to forget what you did. So if the journal entry is granular, if the journal entry is granular or as detailed as possible, then we will be able to then you'll be able to figure it out just by looking at the journal entry. But the moment you group journal entries and take a net amount, then then you will, what you call it, you may get confused. So it's up to you, but remember, it's probably best to take it as detailed as possible. Okay, so what are the journal entries? So the three journal entries, it is the loan, it is the forex on the loan, it is the interest payment with the finance cost, and then number three, it is the repayment of the loan. So let's deal with the first one. So it is again the loan amount. So we go to the journal, we go to the question. And what was the exchange rate on 28 February 2020? As you can see, the exchange rate on 28 February 2020 went from 11 Rand 80 to 14 Rand 65. So now at 28 February, we're going to be paying more. So what does that mean? The loan is going to increase. So that means the loan is a liability. So the liability is going to increase. Because the liability is going to increase, we're going to credit the loan amount or the loan account. So we're going to say credit loan, SFP, and as it is, and then by default, the debit is going to go against Forex. Okay, so what would we do? It's going to be 240, 123 multiplied by, what was it now? 1465 minus 11 Rand 80. Okay, so we're going to say equal to 40, 123 multiplied by 1465 minus 11 Rand 80. Okay, so that will be it over there. And there we go. So that is the loan, as the Forex on the loan. So the next thing we're going to do, we're going to deal with the finance costs. Okay, so the next thing we're going to do, we're going to deal with the finance costs. So once again, we're incurring finance costs. So this journal entry we're going to process. We won't deal with the plant because the plant and the borrowing cost was only recognized at that point in time, so we can ignore that line item. So it's a finance cost, and it's going to be the bank payment, and the balancing figure would be the Forex gain or loss. So what is the bank payment? Once again, it's going to be 240, it's going to be $240,000 times the interest rate of 10%. But now the exchange rate must be the spot exchange rate, which is the 14 Rand 65, because we're making the payment on 28 February 2020. The exchange rate at that date is 14.65. We are making a payment, so bank is decreasing. Bank is an asset, so assets are decreasing. Assets decrease on the credit side. So I'm going to say equal to 4123 times 10% times 14.65. Okay, then we're going to make then we need to recognize the interest expense. Once again, the way we so remember, so the way we recognize the interest expense is the same. Just do this here. Okay, so the way we recognize the interest expense is the same. It is the interest, the loan amount, the outstanding loan balance, $240,000 times the interest rate, 10%. But now we must use the average exchange rate for the 2020 financial year. The average exchange rate for the 2020 financial year is 13,225. 13,225. So the finance cost is going to be 240,123 times 10% times 13,225. So what do you know? So there will be a forex adjustment, and the reason for that is the payment is based using the spot rate, whereas the finance cost is based on an average. So therefore, even though 240, 240, 10, and 10 is the exchange rate that is different, that is causing us to have a balancing figure, and that balancing figure will be the forex. Okay, so here you can see the balancing figure will be between that and that. Okay, so that's the balancing figure. So lastly, now we're going to deal with the payment. Okay, so what are we going to pay? We're going to make a payment, bank, and what are we paying? We're paying the loan balance. So that means the loan is decreasing. The loan is a liability. The liability is decreased on the debit side. So how much are we going to pay? Remember, the amount that we ultimately going to pay is the 240,123 multiplied by 1465. So it's the 240,000 times 1465. So this is going to be 240,123 times 1465. Okay, so that is what we are paying. And you should be able to get that loan balance by doing the following. So if I just show you over here, 1 March. Okay. So 1 March, it was equal to, so on 1 March, we had a credit of 3108. Okay. Then 28 Feb 2019, 28 Feb 2020. So there's on 1 March is a loan transaction, and then also on 28 February there's a loan, a debit of 276. A debit means we must decrease. Okay, a debit means we must decrease. So I say minus 276, and this year was forex. Okay, and then again on 28 February, there's a loan, a credit balance of 684. A credit balance means it is positive. So just before we make payment, how much do we owe? It should equal to the 3516. Okay, so it should equal because we made all the necessary forex adjustments. Okay, so when you make the payment, the loan balance becomes 0. So now we make the payment. We can see there's a debit to loan, so we make it negative. So now the balance after the payment is 0, as we expect. So you can see the journal entries. The journal entry for the loan makes sense. Okay, so that is everything over here for the loan, 14 marks. So hopefully this is quite simple for you guys. And if you get a question like this, you can get the full 14 marks, and that means you have 14%. Okay, any questions before we go on to part B? Oh, did I do it on part B? Any questions from your guys' side? So no questions, so we're okay. Okay, so so remember, all I'm gonna do now is I am going to set up part B. I'm not gonna start it because there's no point starting part B. We want to do it from start to finish. But I want to set it up so you can just, so that when we come tomorrow and work through part B, you at least have some framework as to what you need to be thinking about. Okay, so if we look at part B, let's see what the required is for part B. Okay, so here you can see for part B, so for part B, what you can see over here, they say disclose the following categories of assets for the plant cash generating unit only in the notes to the financial statements of Cable for the year ended 28 February in terms of those 2 paragraphs. Okay, so the one land, buildings, and plant. Comparative figures are not required. So this is basically when you go read this up. Okay, when you go read this up, what you will see, it is the what we call that. It is the PPE note. Okay, you know that recon, the PPE recon. Okay, so all that's happening over there. So basically, they want land, they want buildings, and they want what was the other one? Plant. Okay. So we need to disclose this. So all that's happening over here, we will basically, so remember what we're trying to do. In most cases, a note disclosure is explaining how an opening balance went from the opening balance to the closing balance in many cases. Okay, sometimes that's not the case, but many times a note disclosure is all about explaining to the users of financial statements how the opening balance moved from the opening balance to the closing balance. So basically all we are doing, we will start off with the opening balance. Now remember, on the balance sheet, PPE is shown as carrying amount. PPE is shown at carrying amount, but carrying amount is made up of two amounts. It's made up of cost or gross carrying amount. We use the word gross carrying amount when we deal with revaluation. So I think land is revalued. So therefore, we will say carrying amount less accumulated depreciation and impairment. Okay. So remember, the balance sheet shows carrying amount. 28 February 2019. So that means this is 1 March 2018. So remember, this is what the balance sheet shows. The balance sheet shows carrying amount. So when we disclose, we need to show how the carrying amount went from the carrying amount to the closing carrying amount. And we also need to explain to users that the carrying amount is made up of cost and accumulated depreciation. There's no account called carrying amount. Carrying amount is cost minus accumulated depreciation. Okay, then we will have movements. So what are the movements? We'll come there now. So then we're trying to go from opening balance to closing balance. Okay, so from opening balance to closing balance. So carrying amount goes from, so we have cost, accumulated depreciation, and we have our carrying amount. So remember, on the balance sheet would be those amounts. On the balance sheet would be those amounts. Then we explain to users that carrying amount is made up of those two amounts. But we also explain to users how did the opening balance go to the closing balance. Now, basically, there are multitudes of things. So I'm going to mention typical ones. And then when we deal with the question tomorrow, we will see which ones are applicable and which ones are not applicable. But I'll just give you as much as comes across my mind now, and then we can see what is applicable and what is not applicable. So the typical ones, as we would know, would be additions. Remember, all I'm writing is not all applicable to this question. Remember, we're not just focusing on this question. We also want, when you do a different question, there may be other items in there as well. So additions, disposals, depreciation. Okay, so these are the typical ones that you know. Then there could be impairment loss. There could be reversal of impairment loss. Okay. Remember, there could be a revaluation gain or loss. For CTA 2, there could be borrowing costs. And in this question specifically, and there's also for CTA level 2, because this issue is dealt with in investment properties, and CTA level 1 doesn't cover investment properties, and that is the issue of transfers. Okay, so remember, in this question, in one of the properties, for part of the year we leased it out, then part of the year we converted it into using it. So it went from investment property to PPE. Okay, so those are typical ones. I don't think I missed anything else. Additions, disposals, depreciation, impairment, reversal. They may split impairment out, but we will see. They can say impairment through P&L. It's not technically correct to say through OCI, but I think just to because you don't really have an impairment loss going through OCI, but sometimes they split it like that. And when we come through it, I'll just clarify, because you don't actually have impairment loss through OCI. It is just part, I'll explain it when we do it. Okay, so just take note of that. So take note, you don't really have an impairment loss through OCI. An impairment loss through OCI is merely a revaluation loss. Okay, so an impairment loss through OCI is actually a revaluation loss. Okay, so we will deal with that tomorrow. Intention disposals, what else can come through here? Impairment. So these are the typical ones that would impact what can cause this balance to go from opening to closing. What's going to be important, you're going to need to know which of these amounts impact carrying amounts and accumulated depreciation. So for example, additions impacts cost. Disposal impacts cost and accumulated depreciation. Why? Because a disposal is made at carrying amount. And what is carrying amount? Cost minus accumulated depreciation. Depreciation impacts accumulated depreciation. Impairment loss impacts accumulated impairment. Reversal of impairment impacts accumulated impairment. Revaluation gain or loss goes over there. Gross carrying amount. Borrowing costs includes the cost. Okay. Transfer also impacts costs. Okay, so just take note. So we will just deal with that tomorrow, and then we will see how it works. Sometimes borrowing cost is not shown separately, it is included in addition, so we can see how we will deal with it. Okay, I want to highlight this in red because I don't want to actually call it that, because I don't want to do that. Because you can't say impairment loss through OCI, because impairment loss does not go through OCI. The portion of impairment that goes through OCI is as a result of a revaluation loss. Okay, so that is all I wanted to cover for now. Okay, if you have time tomorrow, you can try to attempt it before the class, but basically tomorrow we're going to spend our time going through completing part B, which is basically this this recon. And obviously this recon is simple, but obviously getting the numbers can be a little bit more challenging. But remember, the whole purpose of this course, this Accelerator Bootcamp, is to help you to make the difficult concepts easy. Okay, so that's what we're going to do tomorrow. So that's all from my side for tonight. Is there any questions from you guys before we go? If there's no questions, you guys are good to go. Okay, so there's no questions. So in the next minute or so, I will stop the class.
I don't really have a question.
Yeah.
I just wanted, actually there's a question now that I think about it. I just wanted to be like, so after we write the mock exam,
Yeah.
and you give it back to us after marking it,
Yeah.
can we have like a Q&A where we go through it like briefly? After we've done it and you've marked it, we have just a Q&A where we go through briefly, where we can actually ask you where we messed up and stuff.
Yeah. So if you want, yes, then I can organize that with you. Yeah.
Okay. No problem.
Cool.
Thank you so much, Faiz.
Okay, pleasure. Bye-bye.
Bye.